Hi, welcome back to another Econ Podcast with Mr. Hagan. This on Econ Podcast, we're going to continue to talk about investing. Please remember this video is not designed to give investment advice. Its purpose is educational only. This video and other videos in the playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. Okay, so we've been talking about on some recent videos, we've been talking about the random walk theory, the efficient market hypothesis theory, efficient market hypothesis, and we said one of the big ideas is risk and how to manage risk. And so we've been talking about what are the different types of risk. I said on a previous video there are two types of risk. The first one was specific stock risk, which this is a no-brainer. Specific stock risk can be completely eliminated through diversification. You can just eliminate it without suffering any loss in your returns by engaging in diversification. So that's specific stock risk. The second type of risk is what is called, the second type of risk is what is called market risk. Market risk is the risk that the entire market will go down. So, you could be completely diversified. You own the whole market. You own the total stock market index. But the whole thing might go down. And this cannot be eliminated. This cannot be eliminated. You cannot get rid of market risk. Okay, you can eliminate it. However, you can reduce market risk. And the question is how? How can you reduce market risk? Well, you can reduce market risk by holding for the long run. You can reduce market risk by holding for the long run. So I want to look at a chart to kind of show that this is true. And by the way, what is the long run? Probably 10 or 15 years or more. Many financial advisors would say you really shouldn't be invested in stock unless you plan on holding for at least 10 to 15 years, something like that. So stocks, typically, financial advisors would not tell you to be in stocks if you're, saving money for 1 or 2 years or something like that. Investing in stocks is a long run commitment. It's a long run commitment, and that's what this market risk concept is getting at. So let me provide some evidence that you can reduce market risk by holding for the long run. So if we take a look at this chart comes from my source is getrichslowly.org. And what this chart does is it looks at the return of common stocks from 1950 to 2002. Now you can find more of these online that will get more up to date, but this captures the concept that we're looking at. So another way to think about risk is to think about spread, is to think about what if you invested your money in the market for just 1 year. So you're going to take your money and you're going to buy stocks. You're going to buy, say, the total stock market index fund, and you're going to hold it for 1 year. And that's it. At the end of the year, you're going to sell it. Well, what could happen? Well, any of these years, 1950 to 2002, if you look at those years, the average return is right here, something around maybe 12%, something along those lines, maybe a little bit higher. Okay? That would be your average return. Any 1 year that you pick would have an average return of all those years together would be 12, 13%, whatever it is. However, the best possible year is you could have had a year where you got a 52% return, almost 53% return. That would have been possible. But it also would have been possible that you would have gotten a year where you had a 26% loss. That would have been possible too. And so this spread right here, this range, that is your risk. Okay? So if you take all your money and you put it into the market for just 1 year, you might get lucky and have that really great year. You might get really unlucky and have a really bad year. But on average, if you did this, you would get, 12 to 13, 14% return. Okay? That's if you chose to invest your money for just 1 year. What if you said this? What if instead you said, I'm going to commit myself that when I buy stock, I'm going to put my money, say again, into the total stock market index fund, but I'm going to commit to hold for 5 years. Well, what was the best 5-year period? The best 5-year period from 1950 to 2002, the best 5-year period would give you a return of 24% per year. These are all per year. You got a 24% return per year over that 5-year period. The worst possible 5-year period was you lost 2%, 2.3%, that you lost 2% per year. That was the worst 5-year period. And the average 5-year period, again, was a little bit lower. It might have been like 11 or 12%, whatever. Okay, that was the 5-year period. But what you can see, what's really important here, is if you commit to leave your money in the market for 5 years, the spread is less. The risk is less. Okay, there's less risk between the highest and the lowest. Okay, now, what if you commit yourself to 10 years? Now, here's why I said back here, here's why when we talk about holding for the long run, that we're usually talking about 10 years or more. Because from 1950 to 2002, look at this. The best 10-year period was 19% per year. The worst 10-year period was you earned 1.24%. That was the worst 10-year period. So listen to what I'm saying. There was not, from 1950 to 2002, there was not one single 10-year period where you lost money. If you promised to hold, if you made the commitment to yourself, I'm going to put the money into a stock market index fund, I'm going to hold it for 10 years no matter what, there was not a single 10-year period over this time range where you lost money. Okay? So that's pretty powerful. That's this idea right here, that if you hold for the long run, you reduce the risk. If you commit yourself for holding for the long run, you reduce the risk. Okay? Again, the spread is smaller. Now, I think I'd have to go back and look at it. I think since the year 2000, I'm making this video in 2020, so I think if you look between 2000 and 2020, there might be a 10-year period where you lost money. Okay? I don't think, I'd have to go look, but well, let's just say this instead of me saying it. Let's just look at it. What about a 15-year period? If you bought stocks in a diversified index, if you bought stocks and you promised yourself to hold those stocks for a 15-year period, the best 15-year period was 18% a year, almost 19. The worst was 4.3% per year. But again, look at the worst. There was not a single 15-year period where you lost money. And look at the spread. The spread is getting smaller. And the average, it's really not moving very much. Let's go out to the extreme, 25 years. If you buy stock in a diversified index fund and you commit yourself to holding that for 25 years, if you commit to do that for 25 years, the best 25-year period, 17% a year. The worst, here's the amazing thing, the worst 25-year period was 8%, 7.94%. So we'll just call that 8% per year. That was the worst 25-year period in this time. Okay? With the average being, somewhere around whatever that is, might be like, if you come across here, might be just around 10, 11%, something like that, whatever it is. But here's what's important. What's important is, look what happened to the risk. Look how small the risk is when you commit yourself to hold for the long run than when you try to invest money for very short periods of time. Then you have much higher risk. So let's just go back and say that concept again. The concept is this. If you commit to holding for the long run, that will significantly reduce market risk. And the longer you hold, the more reduction in risk. The longer that you hold, the more the reduction in risk. Okay? So here's a concept that, and we'll talk about this on some future videos as well, but here's a concept for the efficient market theory, for the random walk theory. The idea is simply this. Diversify your portfolio. That means buy an index like the Total Stock Market Index Fund and hold it for the long run. Okay? And that will eliminate specific stock risk and reduce market risk. It's that easy from the random walk point of view. All right, this has been Mr. Hagan on another Econ podcast talking about risk. Thanks for joining me. and we'll see you on the next Econ podcast.